what a day to talk about volatility. I was going to say that the hottest trend in markets at the moment is having investments in funds that make volatility disappear, and I reckon people are feeling pretty good about that today given the volatility in markets. But what I want to talk about from a small cap investing perspective is how active small cap managers actually take advantage of that. They turn volatility into alpha. We've heard a little bit already about some of the inefficiencies of the small cap market. This is another big difference that people probably underestimate between large and small caps and where a lot of the return opportunity comes from. So let's have a look at why that exists. Now, Matt Fist already showed you some charts showing the difference between small and large cap managers and versus the index. So I won't go over it again, but one point I would raise, or just highlight here on the right, is the difference between the median active large cap manager and its benchmark and the median small cap manager and its benchmark. And I want to look at that through the lens of volatility and how volatility creates opportunities for investors to generate alpha. And in more efficient markets, you actually see less volatility in what counts. Now what counts? What am I showing you here? Well, these two charts are consensus earnings expectations for the major banks on the left and some other top 20 industrials on the right. And what it shows you is this market is pretty efficient. Those lines don't move very much because they're so well covered. These businesses are so well understood. The opportunity for a major dislocation in expectations to take advantage of as an active investor just doesn't exist in the same way. Now you're probably looking at this thinking, that's just a chart crime. You've just zoomed out on the y-axis to make it look like those lines aren't moving. But just hold that accusation for 1 second. Because if we look at the small cap market, we've had to actually zoom out further to capture just how much earnings expectations are changing. And this is only over a space of 6 or 7 months. So from June last year to reporting season, you can see we've got retail and healthcare here, but we could have picked a range of different sectors in small caps to show you how much earnings expectations change and how much volatility exists for active managers to take advantage of. And so the skill really comes in the managers you've seen today trying to be on the right side of that chart, right? Volatility is not great if you're picking all the stocks at the bottom, but it certainly provides us opportunity that really exists in a far smaller way in other parts of the market. So I'll give you some examples of how we look at that volatility and where the opportunities may be today. This is the retail sector. The chart on the left are like-for-like sales growth numbers from 33 brands that we follow across the market. So this is all bottom-up. What are these individual brands doing? And so there's a lot of time series volatility here, right? Every half year, the numbers going up and down. We've got economists and strategists forecasting what's going to happen to the consumer, what will interest rate cuts do, huge amount of volatility. The good news at the moment is we're back into growth. Like-for-like sales are growing again. It was pretty dire 12 months ago. So that's one form of volatility. It's not something we spend a lot of time trying to out-predict economists on where the consumer's going. We spend more time on the right-hand side here. And this is more of what drives those earnings differential charts we saw before. It's which categories are doing better or worse, but arguably more importantly, which management teams are executing better or worse to drive these differentials in growth outcomes. And hopefully if they're controlling their costs and not discounting too heavily to get those sales, that's dropping through to earnings. So that's one form of real world volatility that we're dealing with. And these are the numbers coming out of the first half result that we've just been through. But I want to also talk about how volatility can hide opportunities. And so the first stock I'm going to talk about with respect to that is Harvey Norman. Now Harvey Norman, if we took their $5 share price, is that Jerry? If we took their $5 share price and we separated it out into two components, we can take the property at book value and then we can see the implied retail value that's left over, right? And this is how people try and consider what is the market paying for the Harvey Norman retail business. And you can see there versus the peers, the implied value if you use the property at book is a significant discount to other traded retailers in the market, at which Harvey Norman is probably as good, if not better, than some of those on the page. Now, this is interesting, but we're not the first people to sort of highlight this. In fact, I'm not even the first person in this room to highlight this because Matt and Marcus told you about this 2 years ago. What we do think is interesting, though, is the assumption of just using book value for the property on Harvey Norman's books. Now, Harvey Norman's quite unique in that they own far more property than they need just to house their stores. Most retailers don't own any property at all. Harvey Norman owns a huge portfolio. So the question is, what is that worth? Is book value fair? Is the in-use valuation of that property the right valuation to use? So we'll walk through an exercise here with one of their sites. Now this site isn't even in the top 20. It's one of the smaller sites in terms of valuation on their balance sheet. We think it's worth about, or carried at about $40 million at the moment. So this site is in Macquarie Park, and you can see it outlined there. And in 2013, they applied to have it redeveloped as a mixed-use commercial and residential development, so they put the stores back in at the bottom. You can see there's the store over there from the street, and this is the top view from Google Maps. In 2019, next door, Lachlan's Village was built. So the council said no to Jerry in 2013, and then 900 apartments were built next door, and you can see underneath there's a Coles and some pharmacies and things. And the metro station at North Ryde opened in 2019 as well, 600 metres away. Since that time, the state government has realised to solve the housing problem in Australia, you've got to stop just subsidising the demand and providing incentives to buyers. You've got to increase supply. And to do that, we need to build more houses in areas near infrastructure. So contrary to what happened in 2013, under the state's new transport-oriented development plan, they've reviewed a lot of the land around Sydney, and they've reviewed the zoning that these properties sit on. So it's gone from purely commercial to late last year. Zoning was approved on that site for mixed-use commercial residential. So what does that mean for the $40 million that Harvey Norman carries that property at? Well, there's Lachlan Square Village at the top. You can see it's a smaller site. They built 900 homes on that. The site that Harvey Norman has at Macquarie Park is even bigger. Now, when we did this analysis, we made the assumption they had a floor space ratio of 2.5 to 1. Floor space ratio defines how many apartments you can build and how high you can go. And using that, we arrived at an alternate use valuation for that site as it stands today, because it's been rezoned, of $200 million versus the carrying value of 40. So you can see significant valuation uplift. Now, not every property in Harvey Norman's portfolio is going to look like this, but we think there are quite a few. And we think as this rezoning happens across the country, we will see these valuation uplifts. The actual zoning they got was for a floor space ratio of 5 to 1. So even though that looks aggressive, that we've said this $40 million site's worth 200, that's probably conservative relative to the zoning that they got approved for. So if you put that all together, here's what we have. We have the implied retail value and then some upside if we say the retail business should trade closer to the comparables. We have the property at book, and we have this huge amount of option value that we think over time, this is not a short term, this will happen in 3 months story, but over time, we think this value will be unlocked inside the Harvey Norman business. So that's an example of where volatility and focusing on Harvey Norman as a retailer can completely miss where some of the value creation may come from in the next 5 to 10 years. What's another example of volatility? Well, this is the more classic volatility that we come to expect from small caps. The stock's Megaport, and over the past 10 years, the volatility in the share price has been enormous. You can see there from $2 to $22 and almost all the way back again. Now, when we think about taking advantage of volatility, it's really waiting until that stock lines up with all of our investment criteria to make an investment. And one of those criteria is value. I've given you a couple of illustrative valuations for Megaport to try and frame where the stock has been versus what we would say is fair value over that journey. And on this chart, I've just flipped that into a premium or discount to the average of those two numbers. And so you can see there for a lot of Megaport's history, and particularly when it was in sort of that tech bubble in 2020 and 21, we would say that Megaport was firmly in hope territory. The fundamentals and the valuation, in our view, simply didn't justify anything close to where the share price was trading. And then, we got all the way into despair until finally we're settling about in reality. Now, we bought Megaport for the first time in the December quarter last year, which opens the question, well, why didn't we buy it in late 2022 here when it was even cheaper in absolute share price terms and versus our valuations? Well, that's only one part. The return is only one part of the investment equation. We have to think about the risk as well. So in the case of Megaport, by late 2022, it was still loss-making. We had concerns over management and governance. We had big concerns over the go-to-market strategy that they were employing in the US. We didn't think it was going to work, and it clearly wasn't working. And they had a very narrow product range. by the end of last year, the business was now profitable. Sorry, I get out of your way here. New management and chair. The go-to-market strategy in the US had been completely changed and it was working, and they have a broader product range and a bigger pipeline of new products. And so the volatility exists, but we really don't have to do anything until a share price and a company lines up with all the things we're looking for to make an investment. So that's another way that a lot of active small cap managers take advantage of volatility. We don't have to buy every stock just because it's popular at a point in time. And so the one last thing I'll talk about is small caps versus other parts of the market. And we've heard about small caps versus large caps. We've seen some long-term charts. What I'm trying to show here is one thing we were hearing from planners late last year around what do I do with my bank holdings? They're a big part of my portfolio. They've done really well. How does small caps fit into that picture? Well, we've mapped back 3 different regimes over the past 15 years where small caps versus banks have had very different experiences, right? So first 4 years, banks outperformed small caps by 80% cumulatively over that time. Next 5-year period, the complete opposite. Banks underperformed small caps by 74%, and we've just come out of a period where banks have outperformed small caps by over 100%. So things change, there are cycles, banks won't outperform small caps forever, and so we pose the question, what should your portfolio look like if you think the future may be slightly different to the last 5 years? That's what the ASX 300 looks like today. So if you're building portfolios that are close to the index, you have 26% of your portfolio in banks and 11% in small caps. And I'm guessing that every presenter that gets up here today would say at least this is what your portfolio should look like. 50% small caps, next 5 years. So that's the ideal, that's not advice. That's just my personal view. So Longwave have a process that tries to create consistent alpha out of a really volatile part of the market. And I've given you a couple of examples of how we do that. And you can see at the bottom there, we've tried to label value and growth markets, and the line is just our excess returns over time versus our benchmark. We are a base fee only, no performance fee fund, and so that can be quite useful for planners who are using small caps in managed accounts where performance fees can be difficult to handle. Thanks very much.